We are now live here. It is our halftime report, the daily show we put out here at Tackle Trading on our YouTube channel. One step at a time, analyzing the markets, the news, the charts, the economics, anything grabbing our attention we think is important, interesting, and giving you guys some insight so you can better run your daily routine. If you are a veteran of my community, welcome back. It's great to have our community coming in here, joining the conversation. Let's get the positivity up. Let's get the conversation going. Hashtag Team Tackle right in the chat, and let's rock and roll there. If this is the very first time you're watching our show, we do this show each and every day whenever the markets are live. We're a community that teaches people how to understand the financial markets, invest better, trade better through their own decision making. Make sure you click subscribe, click the bell, and come back and join us. We got a jam-packed show here today. We got market volatility. We got to break it down one step at a time. A lot of action going back and forth in the charts. Some underbelly stocks that are getting rocked right now. Bitcoin's selling a little bit, but still as high as it was like last week. So we'll take a look at it. But a lot of craziness going on out there across the market. We'll analyze it one step at a time. Matt today, Mark today, myself as always, and we have the queen here, our guest, coach from Tackle Trading and the Women in Trading group over there. I'm going to start with Emily, actually. Emily, how are you doing today?
I am doing wonderful, Tim, coming off of a wonderful webinar with the ladies on Friday. We had such a great time. So, we always chat and talk about all kinds of things. And we had a really great conversation on Friday. So I'm really excited for that. If you guys missed it, catch the replay on Tackle. But I'm doing great. We actually have some sun today. There's no snow. We haven't had snow. We had snow yesterday, but we have no snow today, but it's good to see the sun out today.
So is the snow melted, or do you still have the
it's
remnants
melted.
of the storm?
There's still some in the grass areas, but what we had yesterday is melted off the roads. But it's just good to see some sunlight.
Absolutely.
Really.
We all love that sunlight coming in to our life. Absolutely. Matt, how are you doing today, sir?
Tim, I'm doing fantastic. Excited to be with the crew to break down the action in the market here today.
And Marky, pleasantries?
Oh, absolutely. Listen, there's a lot to discuss. There's a lot of teaching moments in this market right now. I'm sure we're going to cover them all. A lot of questions on people's mind, and you got a lot of experience here on this show right now. Something Matt said pre-production. I think I just want to emphasize and give you. Listen, it's been an easy market to trade since the election. It's not that you can't make money going forward. I think there's going to be a lot of opportunities, but just smashing the buy button is going to get destroyed by proper analysis and technical analysis and good setups. So I think moving forward, experienced, knowledgeable traders, people that listen to experienced, knowledgeable traders are going to have a much better 2021 than people that might have thought they were geniuses over the last 4 months.
No, stonks don't always go up, but that doesn't necessarily mean the sky is falling either. Let's break it down one step at a time here, and let's analyze it. Let's see what's going on in the action here, Matt. Let's start with the indexes themselves, and tell me, what are you seeing technically here? Obviously, the NASDAQ's taking a hit here today. The S&P is down near the 50-period moving average in a very orderly pullback, actually, but you don't have the same technical conditions on every index. So what are you reading here, Matt?
And you don't have the same technical conditions on every index. You do have a little bit of a difference in the read from a technical, and I'll take a look at all the indexes here in just 1 second. Whenever you start seeing this in the market, volatility starts increasing, the market starts selling off a little bit, the headlines start rotating, you start to see the concerns start building a little bit. And you start to hear chatter and talk over, are we going to see a correction? Are we going to see a bear market? Are we? And these words, I think, spark a little bit of fear sometimes when they're just technical terms. A correction is just a pullback in the market that can come up to about 10% downward movement in price. We call those corrections, but a lot of times they represent really good buying opportunities. And so the phrase and the terminology we use and how we build those headlines into the market, it sparks some fear that kind of leads, the market to a self-proclaimed, direction to a certain extent. And so when you're looking at the market right now and you're kind of cross comparing all the headlines and all the news out there, it does spark a little bit of fear. And I don't think there should be fear in the market. Short-term trends end all the time. And all the time. Here is your long-term trend, just to make sure we're all under the same understanding of the market conditions that we're currently in. Here is the long-term chart of the S&P 500. in this long-term chart, and this is about 10 years of data right now, in this long-term chart, you literally have about 102 different short-term trends in that long-term chart. Short-term trend analysis comes and goes. Short-term trends happen all the time. You can have some of the greatest bearish short-term trends in over long-term bullish uptrends. You can have great uptrends in downtrending markets. Short-term trend is just that. It's short-term analysis. And short-term analysis, well, you got to be able to recognize when a trend based on a theme is over. You got to recognize when that easy money is over, right? When that easy money is over. And I do think that easy money is over. I don't think this bull market is over. I don't think that. Has the Fed said, did Jay Powell say he's raising rates today?
He did not. As a matter
Oh,
of fact,
wait. He didn't say that?
He didn't. No, he didn't.
He said a lot of other things, but
He
I don't
should-
think he said I'm raising rates.
No.
Right? He didn't say that, right?
No,
So
he
I
did not.
don't think this great bull market that's been happening over the last 10 years and the massive price appreciation we've had in the last 3 months is over. That's not what I'm saying. I'm saying this trend is over. This short-term trend is over. And the reason I'm saying that is when you're looking at the S&P 500, and I'll talk about the context of it here in a second, but when you're looking at the S&P 500 here, you are seeing a little bit of volatility shifting. You formed this consolidation high base. It had multiple times tried to trigger above. It couldn't do that. It tested under support multiple times, fought back up, got beat back down. And so you're seeing a little bit of momentum shift here in the S&P. And in the S&P, which is the broad market indicator, this trend has not been violated yet. And it hasn't been violated because you have not violated a support level yet. You still have a technical higher high, higher low scenario. And so in the broad market conversation, you're still looking at a stock pickers market in a general bullish uptrend. That hasn't changed. That's not the trend I'm talking about. The trend I'm talking about is that easy money train that was happening specifically in the Russell 2000, those small and mid cap stocks that were so aggressive following the election of the economy reopening up theme, and the Fed's going to support it, and the fiscal government, the government's going to support it from a fiscal monetary policy perspective, and we're just going to see increasing momentum. That trend is over, and so when I say the easy money is over, it doesn't. I wasn't referencing like, oh my goodness, run for the hills. That's not what I was talking about in pre-production. I was talking about that philosophy of buy every dip, it doesn't matter. That is over. We've seen it in the underbelly. We're seeing it in small and mid-cap stocks. You're seeing a trend get violated. You're seeing a support level get violated. You're seeing momentum shift here to the downside. And so that easy money trend is what I was talking about. That's over. And yes, I do feel like the experienced trader knows how to navigate this a little bit more because they've seen trends end before. They've been through this storyline. I mean, Emily, you've been trading since 2015. How many short-term trends have you seen the end of?
A lot. And that to no longer freak me out. Like, at first when you're brand new, you do panic when you see, and I mean, the market is not even down 1% today on the S&P. The rut is a little bit, but I've seen enough, but now it's like, okay, this is what you expect, especially when you've had such a bull run in the market.
Yeah, and it's that what I was talking about. Again, there is nothing so far. There's nothing technically in the S&P where you're like, oh my goodness, this is the end of the world. Again, look at long-term charts and have just a tiny degree of perspective here. That's not even a retracement on the long-term chart yet. So it's, I don't think it's something we should overtly get concerned about, But I do think we need to get back to a little bit more. Hey guys, let's talk about confirmation a little bit more. Hey, let's make sure that the price threshold is being achieved before we just jump in. Maybe instead of going out and buying out of the money call options on the next fad that's going to drive up 400%, maybe just hypothetically we think about a bull call spread instead to do a little bit more risk adverse, strategy. So it's just a matter of following the price action. And if you were, wanted to open up that risk graph and let it fly this week, maybe shut it down a little bit. Be a little bit more conservative in this environment until we see that environment again where you get that signal where it's breaking out. Because when you're looking at the S&P, you're saying, you know what, a little bit of volatility shift, nothing to be too concerned about. We haven't violated the 50-day moving average yet. We have that ultimate test back here. Let's see how that ultimate test plays out. That's in the S&P. In the Russell 2000, you're saying, you know what, yeah, I love the trend, but you know what, I cannot expect this trend to do this again. Maybe we just start fading a little bit. Maybe we start to see a little bit of neutrality, but this signal here does mean something to me. This signal after a test of the 20, hammer candle, bullish engulfing, confirmation candle, gets beat back up and then reclips that 2200 support level. That means something to me. Following the slowing momentum of this movement that was preceding this type of movement. That means something to me. It means the market is cooling off. And when you talk, and so when you're seeing this technically in the NASDAQ, really just proves the entire point. Shifting momentum, violation of support, trajectory gets more velocity of volatile to the downside. You got concern there. There's no doubt about that. But the concern to me just isn't technically. The concern to me, and again, this is just concern. I do not want this to come across as fear mongering, because I'm not scared and neither should anybody else. You're traders, you've been here, act like you've been here before. So, but in terms of this, what is concerning is the fact of what I was talking about last week, the week before, when I was talking about earnings and the market's response to earnings. We have had a very good earnings season, but the price has not responded to the positive earnings response. We've seen the opposite happen. And that to me is not surprising, given the fact that in the quarter we had such a robust quarter. But yet again, let's take a look at Home Depot here. But yet again, we saw yet another example of a company reporting earnings here today, report a better than expected EPS number, 2.74 versus the expectation of 2.63. Revenue came in at 32.3 versus the expectation of 30.5. That represented a 25.1% growth rate for Home Depot year over year. Guys, we're not talking Tesla. We're not talking your latest EV fad. We're not talking your next micro penny stock that's going to become the next $2 trillion company, which is about as batshit crazy as anything else I'm seeing in the market, in literally the history of the market. It's not like that. It's Home Depot, and Home Depot gets sold 4% on a positive beat on EPS, on a positive beat on revenue that represented a 25% growth rate on a stock called Home Depot. Those are numbers that get gobbled up by investors in Home Depot, and they got sold. They got sold the same degree that a lot of other companies are getting sold on very, very positive beats. And so you're seeing this concern build. You saw, and what was the concern on Home Depot? It was nothing in their guidance, since Home Depot doesn't provide guidance. The concern was this: we just don't think Home Depot can create the 2020 environment where everybody in the world's going to remodel their home. And you know what? They're right. They're not. You can't recreate the 2020 magic for Home Depot. It's impossible. And so there's that concern that you're not going to have all this money that Home Depot makes on everybody and their dog remodeling their home last year. And so there's that concern starting to build. Take a look at PanW today. PANW. Maybe I can learn how to spell. PanW here today reports earnings of $1.55 versus expectation of $1.43. Good beat on EPS numbers. Revenue comes in north of the expectation, $1 billion versus 985. Revenue revenue growth 24.5%. They reaffirm guidance to the top side. PanW getting sold. What's going on here, guys? To me, what's going on is very simply this. In the quarter, and specifically the quarter, we front ran so aggressively this economy reopening up theme, this vaccine virus theme, this thing that it's good. Like, we all want the pandemic to be over, and we all want it over last year. We want it done, right? And we front ran this so aggressively that you created an environment that there was no way that these corporations were going to achieve what they needed to achieve to maintain that price stability at the top end of the charts. I think the only thing that is happening right now is we're seeing a little bit of shakeout and a little bit of profit taking, and it's aggressive, but we're seeing profit taking off of what's been happening in the quarter. The earnings season has been good. We need to give it a little bit of time to let this market shake out. I think it just ran way too hot, too fast.
And I think that's a really, really good take on all of it, quite frankly, because even like just these two examples today, you talk about Home Depot, PanW, they both posted pretty good numbers. They both beat,
I mean, they weren't great reports, Tim.
They weren't blowout, but they're posted.
They're not sell the stock, get rid and run for the hills. They were beat and a beat.
Yeah. And it's just an example of so much price appreciation over a 3-month period. Even if you have good reports, good economics, good data, good earnings, whatever it is, if the market can't buy it from here, that you get a little bit of that sell the news type of situation.
And now that I think I feel like I found an edge on the market, but now you got to see it technically. Now you got to see it technically. And what you're really kind of looking at in the S&P is you're looking at, obviously, all of this starts on intraday analysis. All of it starts on intraday analysis. Look at this volatility right here over the last, since really kind of the cash open here.
And on the cash open,
anybody get a read on that? Literally, can anybody get a read on that?
For many traders that have been started trading anytime in the last 6 months, that was the nastiest cash open you've experienced. Now, it's not the nastiest. I mean, listen, we've experienced traders been through some nasty cash opens. That was a nasty cash open.
Yeah, I was going to say
it was nasty.
You picked 6 months for a reason, because we've been experiencing some pretty bullish conditions in that 6 months. But for traders that have been around before 2020. We saw some nasty cash opens in 2020 at the very start of that pandemic.
And like on that cash open, I mean, just to show you how like I handle it, I see that cash open, I'm like, huh. And you just like, you cannot overreact to a nasty cash open, because that's when emotions are high, and you just have to look at it and be like, all right, I had a game plan coming in. We're going to see how this plays out.
Watermelon tea will help you make those decisions, Tim.
Little foam on the watermelon.
Just a little foam. Maybe a little cinnamon on the foam.
Little meditation session.
Little meditation session. Yeah, all of that will help you out. But when I say it all starts on the intraday, it does. It all starts on the intraday. You have to see the intraday start to get consistent. The daily chart's not going to get consistent until the intraday does. And so when you're seeing this type of movement down, up, crazy volatility, that's not a read. You don't have a read there. You got to let that simmer down. You got emotional. You got punched in the face. Let's see how you respond. You got to let that volatility subside. Let the market have its fight. Let the market have its argument. Let it subside. And then you can get a read on the market, because you get a lot of hesitations in volatility, and they are sometimes big. They'll give you a big misread. Let it simmer down.
Bluntly, if you look at that S&P chart over the last, 15 bars or so, you're orderly going up, green, 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 doji, 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 turning over. There is a lesson here just in the way the price moves. I mean, we had a nice little move up, but now we're having a little bit of a retracement back down.
Well, yeah,
In the averages, it's like,
and I do, and honestly, I mean, when you're looking at the SP, I mean, you're going to be like, oh man, I mean, we haven't seen this low price for 2 weeks. I mean, it's crazy. Yeah, the S&P went from 38 to 39, came back down to 38. It was really done not much. Now, other companies, yeah, they got a little bit more volatility in it.
well, there's a lot of that. We're going to look at a few of those a little bit later in the show as well, no doubt about it.
And again, I just wanted to add some context to why the market is behaving the way it is. I don't think anybody should be running for the hills at this point.
Mhm.
Like nobody.
Let the charts play themselves out. There's so many different
Well,
things that have to work themselves through.
Can
And
I paint a couple pictures
absolutely.
real quick?
I would love to.
Okay, let me paint a couple pictures real quick. First picture I'll paint on is the NASDAQ. Big ugly red, two big ugly red candles, right?
Mhm.
Big ugly red candles. And what do big ugly red candles? What do they represent, Tim?
Big selling. That means there's pressure on stocks. Yeah.
And usually you got some fear out there, right?
Mhm.
You got some fear. Well, and technically, I mean, for us technical geeks, right? I mean, Mark, clipping the 20 like this and clipping the 50 like this. I mean, technical geeks, that's a little nerve-wracking, right?
Listen, I say all the time that, I like that because it was a clean bounce off the 50. Yeah, that was a smash through the 50. That's
Yeah,
really
that was
fair.
Mike Tyson punched you and then bit your ear off. I mean, that was
Because under normal price action, you come down, you test at least in the intraday. It can give out later in the day. You test the 50, it bounces, and maybe it gives out. That was just real fear at the open, just smashing through.
Tim, how long can I keep making the Mike Tyson biting somebody's ear off joke and people like?
As long as we're alive.
I'm just like, how many people don't remember that?
Here's my thing. Mike Tyson's done a lot of other things in his life. Maybe that's not the only reference we could ever give Mike Tyson. Poor Mike Tyson. He can't get past the ear reference.
You thought I said that as a negative?
I don't know what you meant.
I said it's a term of endearment.
All
I
right.
respected the move. No, I kid. But yeah, it got punched in the face and didn't respond very well.
Mhm.
Got knocked down. We don't know if it's knocked out yet. And that's what I want to paint here. And again, you want to see it first. But if we come back on Friday, would anybody be shocked if Tuesday morning represented the low price for the week?
No,
before I break it down technically.
In fact, I wouldn't be shocked at all. No.
Okay. Now, let's look at this from a technical perspective. Number one, you're seeing the exact same type of volatility in the NASDAQ. And the reason I'm looking at the NASDAQ, because I think it's the NASDAQ's the storyline this week. Okay. And so I do think if the NASDAQ finds support, the S&P is going to find support. If the NASDAQ finds support this week, I think it was a scary situation, but we're good. We're good. So number one, we know it violated a lot of 20-day, 50 days, 9, all those short-term moving averages that act as support in uptrends. We know it violated that. So coming back here, we know it violated all these moving averages here. It violated all the previous resistance pivots there. But now you're coming back down into a little bit of a scenario where you have that wick right here. And I am completely overreacting to that wick right there in comparison to that wick right there, in comparison to all this historical chop over here, okay? All this historical chop over there. But that wick right there is important to me because it's right in the zone of all this historical nonsense. Now, coming back down to the intraday chart, let's go to the 30-minute chart here. Now, this wick right there is where it represents all that historical volatility, right there at 12,757, okay? Now, you see this price movement here. This wick was on the cash open, guys. Now, Mark, do you think that was a random generated wick at 12,757, or do you think some algorithms bought it up right there?
Yeah, it was algo buy.
It was algo buy, and those algo buys had to be looking at something historical, right? And I think it was, and again, I don't know this. I'm just widely speculating. I'm pretty certain it was that wick right there. Pretty certain. We'll see. We'll see. Low price 12,727. Low price 12,757. So we're about 30 ticks into that. And 30 ticks on a $13,000 index is nothing, guys. That's like 1 second in price action. Now, coming back down to the 30-minute chart, lots of downward movement in price on the overnight action. That's where most of this pain was, guys, was in the overnight action, right? Now, that's the cash open. Here's the rest of the price action. This is the volatility I'm looking at, though. So if this level holds into this range here, and again, that range goes from that wick. It's not this here, but it's that wick coincide with the other historical support levels. If that range holds here, that trigger right there at 13,100, that is a really, really, really good little trigger. And you look at that right there at 1370 here, that's right where the 50-day moving average is. You come down to the intraday, look at the top pivot there at 1300. If you do see volatility shift, and now that movement to the downside on the overnight yesterday, if we can stick the landing here into this range, everything's back to being glory if we can get above that level at 13,100. Now, coming back down to the daily chart, we violated a lot of support. We're good 7% off the highs, guys. We're into that historical correction territory. That correction territory can come down here too. But if that little intraday pivot holds there and we trigger back up above 13,100 where that intraday pivot is today, I think the parade's back on.
I think.
And so when I say see it, Tim, that's what you got to see. You got to see it stick the landing here, followed by upward confirmation here, and then you can say the parade's back on. It's raining right now, too much rain. Parade's back on if that holds.
Get those floats back out there and throw some candy, I guess. But we got to wait until that rain does stop. There's no question about it. And it can take a couple of days even to chop.
I mean, you
even
got
if
to wait till the
itself.
rain stops. I mean, this is one of those things. When you start breaking support levels, start breaking moving averages, it is patience. It is patience. It's patience. It's patience. It's patience. Because you don't know where the reversal signal will. You can guess. You can use logical experience. But, man, you don't know where it is going to stop.
No, a fart in the wind right now could knock this market down. That's why you got to see it. You got to see that intraday tighten up. And as you see that intraday tighten up, once again, coming back here, as you see this intraday tighten up here, that's going to shift that volatility here. Because look at this. This is just a consistent pullback here. That is nothing to be nervous about in any capacity. That is a beautiful buying opportunity. This volatility, we need to see this overnight action settle down here, and then once again you get above 1300. Party's back on.
I like it. Am I wrong to be more excited about big cap tech than most people are right now? Everybody's calling for the death of it, by the way. I don't know where this is coming from. It's so stupid to me. I don't
they call
get it.
For the death
every time it pulls back.
Here. I remember the one day, this hammer candle right here, I remember people calling for the death of tech before Christmas. And I'm like, you really think Santa's going to do that? Like, no. No, I don't think listen.
Mark, where does the hate come from?
You bet on tech every year for the next 50 years. You're going to make a ton of money. And yes, every now and then you're going to get beat up really bad.
Well, and I know that tech could break support here. It could rally through the intraday. This pullback could play itself out in a lot of different ways, right? So we don't know the future about it, but I'm excited about it. But Marky, where do you think the hate of big cap tech is coming from right now?
People losing.
I don't know. I mean, in the short term, I mean, in the very short term, it's all about, the playbook of when real yields rise, tech goes down. That's just the playbook out. CNBC had about 4,000 articles on it yesterday. So, I mean, that's out there. And, you know, and one of those self-perpetuating things when it happens, right? Well, it's supposed to do it. And so traders start lightening and then selling, and, you know, self-fulfilling prophecy occurs. The long term, I don't know. People probably that didn't get in at the start, they've been waiting for a massive pullback like myself.
Okay, so I'm supposed to buy into the argument because the 30-year note has went from 110 to 130 in the last 2 weeks. That's supposed to end the world?
Wait,
Like,
hold on.
that's the,
Hold on.
that,
Let me
wait,
go sell
is
my Apple
that,
shares.
is,
Hold on 1 second. I gotta go sell my Apple shares because of that.
yeah, like because the interest rate is 1.3% on a 30-year note, that it's game over?
And it's just, I mean, the amount of
I just want
financial
to make sure
media
that people
articles,
understand that that's not intelligent.
you know, the
And
amount
that
of
I'm trying to be nice.
the amount of financial articles that have been pushed down investors' face by the mainstream financial media. I mean, I seriously, and I'm not even using hyperbole. I have probably seen 50 articles on real yields impacting tech in the last week alone.
Yeah, let's go run to the bond market right now, everybody. Let's go get that 1.3 yield now, immediately. Everybody attack. Let's just go dump every stock. We need to go get yield. Let's go get $1.30 on yield. Come on. Does anybody want a Snickers bar in the next 20 years? Let's do this.
Bond yields are sexy.
It's the dumbest thing I've ever heard. It literally is one of the dumbest things I've ever heard in my life. That this party is going to end because of the yield on the 30-year note going up 30 basis points to 130. Oh God! Wait,
Yeah,
cry me a river.
yeah.
Lord
It's people
almighty.
trying to explain the volatility.
Let me
Still trying to
offset that
understand
4% inflationary target. Oh God!
it.
What are we doing?
Silly. It's silly. Bond yields are sexy right now.
I now believe we
Nobody
live in the
ever.
matrix far more than I ever have.
Oh, bro, it's always been a simulation. Don't get me started on that. It's too early on a Tuesday. Come on. We've lived in the matrix for a long time, you know, but not going down that rabbit hole. Let's keep working through the market step at a time. I love the breakdown on the indexes.
I don't know
by
what's
the way.
worse, that or, you know, J Powell trying to explain it's the step in the market cycle today.
Hey, Juan Crew was out there in full force today. Just
Listen, J Powell on the Hill. We'll talk about it. Might as well talk about it right now. Bring up the dollar. Obviously, this could be a market catalyst. He's got 2 days of testimony starting today and tomorrow in front of the Senate Banking Committee. By the way, he speaks in front of all kinds of different committees. So you might feel like J Powell's on the Hill like once every 6 weeks. Feels like that
Yes.
lately to me as well. But this time, the Senate Banking Committee brought him up to talk about the state of the market, state of the economy, all that kind of stuff. Guess what he had to say? Pretty much the same thing.
Hashtag no inflation is what he said.
Or nothing to see here as well.
Oh, hashtag no inflation.
Nothing to see here. And if there is inflation, hashtag it's the jobs market's fault, by the way, is kind of what he implied. You know, they've got that long-term target of keeping inflation below like 2%, right? Mark, he literally said that if inflation goes above 2% in the future, it's because we have a strong labor market that is forcing it, and it won't necessarily make them combat the inflationary pressure. So
well, I heard the lies.
yeah. Matt, what would you read on this?
I'm glad my video camera isn't up right now. What is my take on this? Well, you know, it was interesting watching Jay Powell in his opening little speech and then talking about kind of inflation in the labor market. And I couldn't tell Tim if Jay Powell was trying to blame the labor market when it gets back active, about the labor market being the real cause of inflation. I don't know if he was he blaming the labor market? Was he saying, you know what, guys, inflation is going to come, but when it does, it's not us to blame, it's the labor market to blame.
If it happens in the future, it's because of the jobs market strength. The only way that it could get out of hand, but even if that happens.
So the inflation is justified because, you know, at least everybody has a job. Right? So, okay. So, all right. So Jay Powell is a very, very intelligent human being, and he knows exactly what he's talking about. He just says it differently when he's talking to elected representatives who don't know what they're talking about. So I understand his frustration. But when I was listening to Jay Powell, I'm like, yeah, Powell, that's like the cart before the horse, bro. Like, for the labor market to respond that way, the Fed has to create the environment that will create the labor market. And so I kind of felt like Jay Powell was just kind of laying out the market cycle for everybody.
Mm-hmm.
And so I said, okay, so Jay Powell, you're doing it through a step-by-step process. Okay, good. So I just want to take a moment to help Jay Powell explain the specific steps in the market cycle that causes inflation and forces the Fed to maintain their dual mandate, which at this point I think is 4 or 5 or 6 mandates, depending on the king or queen they serve. Now, step one in everything like this starts with something bad happening, okay? Whatever that something bad is, it always starts with something bad happening. This something bad was a pandemic. Last time, subprime market. Time before that, bubble-like conditions in NASDAQ. Before that, end of the world with savings and loan crisis. Before that, stagflation of the 1970s. Something bad happens. And because of that something bad, the Fed always acts. And what they do, because their first mandate is price stability, and their second mandate is full employment, is they create the environment. Okay, so step one is something bad.
Mm-hmm.
Step two, because something bad occurs, everybody gets fired. All right, massive layoffs everywhere. Everybody gets fired. Step three is when the Fed acts. So something bad happens, everybody gets fired. Now step three is when the Fed starts. Now what does the Fed do? Well, the Fed says, you know what, it is our job to maintain price stability. It's our job to foster an environment for corporations to borrow money to expand their business and hire people. So we're going to lower rates. We're going to lower rates. Wherever those rates were, we're going to lower those rates, and we're going to create that environment. And if we start lowering the rates and it doesn't create the environment, we're going to continue to lower the rate until it does. And sometimes, historically, that's when it comes to 2% inflation. Sometimes it's when 1% inflation, not inflation, 2% interest rate, 1% interest rate. Historically, that goes down over time. So in the 1990s, it was 2%. In the subprime, it was 0. In this time, it's 0 plus quantitative easing infinity plus all these other different micro actions the Fed takes. So they do something bad, everybody gets fired. Fed creates that pro-business environment by lowering the rates, creating an environment for people to borrow money. Borrowing money creates more velocity to money. So once they do that, step 4 is the government acts, and the government starts doing stimulus packages, okay? And these stimulus packages are based on the 1930s economic philosophy on John Maynard Keynes. And he said, let's hire people, build infrastructure, all this jazz, right? So the government steps in and does fiscal policy. In 2000, after the dot-com, what was that fiscal policy? It was the Housing Act of 2002, where we wanted everybody in America to buy a home, regardless of income level, regardless of credit, regardless of if you had any historical ability to pay for that home. We wanted everybody to buy a home so that it would spark velocity of money, spark assets going up. What was it in 08, 09? Well, that was all the quantitative easing and the TARP Act and the ZERP and all these asset repurchasing programs. And what was it this time? It was a $2.3 trillion stimulus package in June of last year. It was the $880 billion package from March of last year. It's the $1.9 trillion in new stimulus the government is going to be approving through the Biden administration literally within the next week and a half, 2 weeks. And so this is that step 4 where the government comes in and fiscally stimulates the economy. Step 5 is the hiring process. And that's what Jay Powell is talking about today, is he's saying, now that the Fed has acted, now that the government has acted, you're going to start seeing, because of these pro-business environments the government and the Fed is creating, you're going to start to see the hiring process come back. And now what the Fed is doing, or Jay Powell is doing today, is saying, because that's going to occur, because the labor market lags the policy, as the labor market comes back, who starts making more money? Consumers do, right? Consumers start making more money. And as the consumers start making more money, what will occur at that point is the M2 rate in comparison to velocity will increase as well. And so what Powell is talking about is, I don't believe he's blaming the labor market. He's trying to describe this process to people in Congress who are, quite frankly, extremely uneducated when it comes to the financial world. And so he's explaining this process to them about how, when the labor market comes back, because we have created this environment where there's all this money, the labor market, you're not seeing real inflation yet because the labor market hasn't responded right. And Mark, Tim, you and I, we've had inflationary conversations many times. And every time we go into this inflationary conversation, I always talk to people about, it's not about the net amount of money in the M1 rate. And what the M1 rate is basically the lowest denomination of money supply. It's liquid cash, basically. Then you have the M2 rate. And what the M2 rate is it's all liquid cash, savings deposit, it expands the M1 rate. And when we're looking at velocity of money, we're looking at it from an M2 philosophy. And so when you look at the M2 rate right now, the speed of money is rocking at about 1.1 right now, which means we only have about 1 point utilizations of money. It doesn't matter how much money you print if the velocity is nothing, guys. And that's what the Fed's looking at over the last 10 years. They're looking at this environment. They're saying, we did QE1, QE2, QE infinity. We've increased the balance sheet by upwards of like $6.8 trillion in the last 10 years, but we haven't seen that ultimately lead to massive inflation, because it's not just about the M1 or M2 rate. It's about the utilization of that money in a system. And right now, since the pandemic, and this is what the Fed is looking at more than anything, guys, more than anything to justify their inflationary mandate, what the Fed is looking at is not the CPI report. That's what they tell you they're looking at, because that's what the public looks at. They look at the PCE report, but specifically, they look at the velocity of the M2 rate. And right now, you're rocking at 1.1. You're not going to create a massive inflationary environment rocking at a 1.1 inflation velocity rate. But what Powell is talking about is, as we've created this massive pool of money, that has access to everyone in America, consumers, corporations, institutions, you name it. As we get further into this recovery and you start to finally see the labor market come back, what their concern is that as the labor market responds, all that pool of money now goes into the consumer hands. And instead of rocking at a 1.1 velocity of money, all of a sudden you start getting back into historical norms of 1.6, 1.8, up into 2 utilizations of money. And at that point, you start to see real big inflationary concerns. And so what I think Powell is trying to get people to understand is, yes, there is obviously concern about how much money we have injected into the system, but we're not ultimately concerned about inflation yet, because that money has not necessarily been utilized in the economic system, and that will not occur until the labor market responds. And once the labor market responds by 2023, 2024, by that scenario, we should see an inflationary situation where that is concerning. And at that point, we will start adjusting rates. And so what he was trying to explain is just the simple process that the market cycle has undertaken literally since the creation of the central bank in 1913. And that's what I think he was trying to get across, is that we're not seeing the inflationary environment yet because this is how this process works. And if we're accurate on how it's going to lay out on the timeline, the inflationary concern will start to occur not today or tomorrow, but in somewhere around 2023, 2024. And between now and then, the importance of us acting aggressively right now to combat the current economic situation is far more important than the hypothetical scenario of hyperinflation if the labor market responds to the degree that we think it would. And so I think he was laying out the process for the central bank in terms of how and what, under what guidelines they would start to adjust the interest rate. And some of that was just trying to explain it historically.
Yeah, but it doesn't feel like they're always moving the goalpost constantly, forever, and
yeah.
so that they can just change whatever policy they want to change in the future to fit the current narrative of what they're seeing in the economy. I mean, at some point, can somebody call him out on this? Like,
well, yeah, I have for 12 years.
They don't listen.
They don't listen. Just listen to me, dang it. No, listen, honestly, he was laying out the process for how this process works. That's what he was doing.
Yeah.
And he's trying, and I get it. You're trying to explain to the uneducated about how this process works. And I get it. You're trying to make it as easy as possible. Listen, it's not easy to explain to Congress how the financial system works. That's not, listen, I had an easier time describing the monetary cycle to my children than I do to Congress. Like, I get it. Pal's got a tough job.
Well, from my ears, what I definitely took away from all of it as I read his testimony, thought about it, is that he's reiterating what he's been saying for a long time, and they're going to keep monetary policy soft and QE soft. And even if bad things do happen through inflation, they'll change the goalpost and make up something new anyway. So,
well, and that's fine. And if that's the whole takeaway, that's the whole takeaway. But I just simply feel it's important to understand what is happening and not just to accept the narrative of what people tell us.
Yeah, I agree. And I appreciate you laying that out, brother. All right, let's take a look at the commodity markets here next. Obviously, the dollar kind of sitting here flat. Crude oil, gold. We did a podcast on energy stocks yesterday, by the way. Crude oil holding up very well here. I'll drop the link to that podcast in. Maybe talk about that for a moment, Matt, while you're analyzing crude, if you can, and I'll grab that link.
Yeah.
Or Mark.
Yeah, either one.
Marky, you kind of were a big factor and part of that feature presentation on the podcast. Why don't you lay that out? Matt might need to catch his breath there for a minute. After all that Fed analysis and whatnot.
Listen,
so yeah,
I mean, we've been pushing oil stocks so much in the last couple of weeks. It feels like we should get a commission, because like you see rotations develop, and sometimes they're nuanced. Sometimes you're like, I think a rotation might here is, and sometimes they just hit you with a ton of bricks. And a rotation into energy stocks over the last couple of weeks has just been one of those easy things to see. The writings on the wall. I mean, CNBC has ran multiple articles on it in the last couple of days. They might have been picking up on us. It's amazing how CNBC is always like 10 days behind what we say here on the show. But this rotation into energy stocks, this rotation into commodities in general, Goldman Sachs, JP Morgan, they have been pounding their trading desk. Embrace commodities, embrace commodities. It's happening everywhere on the sentiment level. On the chart, well, we've seen a price action in the last couple of weeks. And as we've commented several times in this show, in podcasts and other places with our pro members, energy stocks have gotten a break. I think once again today they're getting another break. They're actually up a little bit in all of this mess. If you go to, they're actually up a little bit. They got caught down in the opening bell, like everything in the market did in the opening bell. there is a lot of sentiment here. There is a lot of juice. There is a genuine rotation desire out there amongst the big banks, amongst the financial media, amongst the message boards, amongst everything. Everybody sees it coming. Everybody sees it coming. And they've been held back a little bit. I mean, I know Emily had a trade on XOM last time you were here, the Queen, last Tuesday.
I did.
You know, that trade's been working out pretty well. You know, and this is one of the things that, like, when I look at this, it's like, this is when you see these rotations and you see areas to make money. You know, the market can do what the market does. There's still going to be opportunities, even in bloody markets like we've had in the last few sessions. And with energy, I cannot state enough how much I believe, how much Matt believes. And if you want to hear our full analysis in length, in a length conversation, go to thetradingjustice.com. We did a whole podcast yesterday on the energy sector, why we think, what we're looking at, how to potentially play it. Go to the feature section on that podcast and you'll get a lot more depth. But 2 thumbs up to energy stocks as a position trade for the rest of the year. I mean, it's one of the easiest calls I think there is right now, and everybody's on board. And when everybody's on board, it tends to work out from a sentiment standpoint.
Well, and you know, let me jump on that too, Mark, because I don't think there's any easy calls right now. Like I just don't. I don't think there's an easy theme right now. I don't think there's easy calls. I think earnings season has exposed some of that price action a little bit, or some of the overvalued nature of the market to a certain extent. I mean, how many times have I said during this earnings season, we've had a great earnings season, but we're overvalued now than we have been? I mean, that's what we've been seeing. So I do think earnings season has unmasked that. So I don't think there's an easy analysis right now, quite frankly, especially with the velocity that is currently occurring in the NASDAQ and a little bit in the Russell 2000, and obviously in the underbelly of the market. So I certainly do not believe in the growth argument of the energy sector over the next decade. And I want to make that clear too, because I see this as a unique environment that really does fit the position type analysis, right? Where you're trying to take advantage of something, where you think, where you're trying to take advantage of a current environment, where you're trying to take advantage of something you feel is going to catch up to the market, or you feel is going to outperform the market. And you know, we did the whole late or not yesterday. We don't need to repeat that, because obviously none of us believe you're late to this movement, right? But, and again, I do not believe in the long-term analysis. I just don't. I think the growth area is in clean tech. I don't think the growth area is in energy. Now, the argument of dividend cash flow, price stability over the next 10 years, yeah, but nobody can convince me that the average price of oil is going to be north of $50 over the next 10 decades. I just don't believe that. I think the average cost of oil is going to be far closer to $40 over the next decade than $60 over the next decade. So I don't believe in that argument over the next decade. But I certainly believe, based on what we're seeing right now, that in this current environment, you could see some fairly aggressive catch up to what has been happening more in the broad markets. And quite frankly, the catch up I was talking about yesterday in the podcast was catching up to this price movement over the last couple months on crude oil. And we had a very lengthy conversation on this topic yesterday in the podcast. Mark, you and I, you know, we talked in detail about what we're seeing in this marketplace, and so I hope people get a lot out of the conversation. But I do think energy has an edge on the marketplace over not the foreseeable future, but over the next short term. And this next short term leg in the market, whatever the market does, whether it's up, down, or sideways, that doesn't matter to me. I do believe energy is in an environment to outperform the broader index of the S&P 500, and especially over the course of the next coming into the summer months. Is something we didn't talk about yesterday, but I do believe has some historical relevance pertaining energy specifically, is the seasonality argument. And I know you and me, Mark, we don't love seasonality because it's like, yeah, seasonality, we like to look at what's happening right now, and the unique environments of 2019, 18, 17, 16, 15 have nothing to do with what's happening right now. But seasonality over time certainly does give you a slight edge, and there is some seasonality to the bull on energy outperforming the S&P in the months of February, March, April, and coming into the very, very utilized heavy summer season. And so you do have that as a little bit of a tailwind as well. But yeah, I certainly think energy could catch up to the S&P, and I have it slightly higher rate. I know the tackle trading one has the S&P slightly higher rated, but personally, I have energy slightly more higher rated than the S&P right now.
Well, it's outperforming here in the short term. There's no doubt about it. And it's got a really wonderful and beautiful trend. And I love the conversation. Make sure you go listen to the podcast. No doubt about that. But a lot of that conversation and the logic behind it was crude prices, obviously. And I do want to look at crude at some point too.
And again, crude and energy, when you look at these historically, and let's just take a quick peek at them historically. We're not going to do anything detailed here or anything, but we're just going to look at a nice little weekly chart over the last 10 years. Okay, nice little weekly chart of the last 10 years. And let's take a quick peek at good old-fashioned crude oil here, /CL. Okay, this is the last 10 years, okay? From the years, and again, lots of short-term trends here, but overall wide range neutrality between 80 and 110 is what you pretty much have in this environment. This, just to repeat, for those of you who were not alive in the market in 14 and 15, this, we all know what happened here. Everybody that's ever been around the oil market knows exactly what led to this. And who do we blame, Tim? Who do we blame for this?
For the crash in the oil markets?
In 14 and 15.
I thought we don't we always blame the Saudi princes? I mean,
it's always the Saudi princess, because the Saudi princess said, we don't have enough money. And so we're going to corner the market by lowering aggressively the value of oil, killing all the US and Russian frackers in the process. And I remember saying at the time, you'll win the battle, you'll lose the war, Saudi Arabia. But that's what transpired here. Okay, and then we get back to just the normal neutrality, and you see this upward movement in price here. Now, I want you to look at that 50-day moving average right here. Okay, look where the current price is, look where the 50-day moving average is. Now, let's take a look at energy. Now, there's only 2 times on this chart where you can easily identify energy disconnecting from crude oil. Only 2. They are this environment in 2013, this environment here, and this right now. That's the only difference. Outside of that, you have the same type of price action. Get caught up in Saudi Arabia, wide range neutrality. We all know the storyline of 2020 and the recovery. Now remember, where's crude oil relative to all these moving averages? Crude oil is up here. That's where crude oil is. This is where energy stocks are. This is a W formation that, not this candle, last week's candle was the confirmation candle. This is the continuation. Now, only this time here and this time here have you
either he stalled, froze, or I did, which is always that.
I immediately went to do the same thing. I was like,
symbol here, energy disconnect from its mothership.
Hold on, the mothership is now downloading data. I'm hearing it.
Is the mothership back?
I heard the mothership transmitting data to Earth here. All right, you're back. It was
mothership.
It did
one mothership back.
It tried to just bring all of your audio to us in like 3 seconds. So
you know what?
It was funny. I liked it.
well, leaving from the rover space station that is circling Mars with Elon Musk. You just don't know that right now. Okay, back to my little analysis here. Can you guys hear my audio now?
Yeah, and we had you all the way up until the breakout analysis right here.
Okay, so now coming back to this environment here on energy, what was this environment here? Well, that was QE Infinity.
Mm-hmm.
That was the $85 billion a month that we injected into the financial markets directly. And we literally called it infinity. That's not me making that up. That's the Fed saying infinity, because and I remember we all were making the joke, to infinity and beyond, right? To infinity, like we're all going to Buzz Lightyear this. So infinity, because the first two times they said quantitative easing, they give expiration dates to it. And when that expired, the market sold off 10, 12% respectively. So on this one, they said infinity. And look at that nice little trend. Look at that momentum take off in that environment. Well, currently, you have a very similar environment to what we were doing back in 13. I would say it's actually
Mothership
got him again.
You do better than QE Infinity. I swear this is the Fed trying to stop me.
No, it's the Saudis. You talking the Saudi guy.
Or the Saudis.
We didn't have any problems.
I start talking to the Saudis, and you look what happened. You know where the real power is. It's not the Fed. It's the
They're
Saudis.
like, yeah, win the battle, lose the war. I'll show you.
How dare you go against the empire? Saudi Arabia, I have a lot of other really nasty things to say about you if you want to listen in other channels. Now, if you look at this very quickly, only two things can occur here. Either one, the movement in crude oil, and I'll finish this very quickly because it's like, I don't know how long my internet's gonna stay with me. Either one, your analysis has to be that crude oil is going to come down aggressively and come back down to some degree of correlation with energy, or two, energy catches up to crude. And when you're looking at a theme that is pro-energy, pro-economic opening, pro-vaccine distribution, and crude oil is front-running that, I haven't seen weakness in crude yet. I think energy catches up here.
Yeah, and just one last stat to throw on that. Yesterday, saw the most net buying in energy stocks in the last 2 years. So people are flowing into it.
Money's flowing. Yeah.
And when we say those people, I hope those people aren't on your message boards, Mark.
No, this is institutions. This is money.
Because those message boards, like I'm thinking, okay, I had a position
the
trade. Now I'm thinking day trade.
Are like, you guys stop selling.
I need a segment where Mark, because Mark spends quite a bit of time in the underbelly of the market.
Oh, listen, those message boards, people won't chase oil until XLE's at $77, and then they'll jump on the board.
Craziest things he reads.
I agree. And if Mark found some of the craziest things he read on message boards and shared them with us here on the halftime report without a filter, that would probably be pretty scary. As a matter of fact, I'm not sure I want to know what they have to say in the underbelly and on these message boards. I kind of like the ignorance is bliss, thing I've got going over here.
Okay, what's more risky, buying an out-of-money call option on CCIV today, or letting Mark Unfiltered talking about his comment section?
Define risk.
To the world.
Yeah, the comment section is more risky.
Okay.
Message boards will get involved when XLE's is in the 60s, and then they'll want to chase it like they want to chase everything.
Let me just put it like this, Tim. I'll have personally less stress in my life if I buy an out-of-the-money call option on this candle versus letting Mark Unfiltered on the halftime report.
I agree, for me personally.
That's a GameStop candle.
No, that's not. That's a Nicola candle. I don't necessarily.
That's a Nicola candle.
That is a Nicola narrative as well.
We'll talk about CCIV.
Just in a minute, though. Let's do gold here first. Little doji candle in the middle of a range. Not much there. Don't need to update the analysis. But I do want to talk about crypto and Bitcoin a little bit here on their chart. If you got anything you want to add on gold, go ahead. I mean, nothing there I'm seeing, but
I have nothing to add on gold until we start seeing something. Like the same levels need to shake out. It's going to take time.
Can I talk to Jack Dorsey for just one moment here? Jack, I don't know if you're watching the show, but whoever's writing the trending, news items on Twitter, Bitcoin's not down because Janet Yellen's talking about it. Let's just make sure we're clear on that. That was the exact thing on what's happening. Bitcoin's crashing because Janet Yellen decided to talk about it and all these different problems. No, that's not what is going on. Bitcoin just has some crazy volatility here. It's obviously coming off the high 57,000 down to about that 46,000 mark.
It's amazing that Bitcoin's in an amazing bear market right now.
Yeah.
Bear market territory. It's true.
Listen, keep falling. I want to buy some. Like, listen, I mean,
Dude, I like this segment. I like a segment. Like remove the veil here, Tim. Let's have a segment where Matt and Tim and Mark just talk to the CEOs of America about how dumb they can get sometimes. Like, I love this. I love this. Remove the veil. Tim, you talk to Jack Dorsey right now. You tell him everything you need him to know right now.
Yeah, hey, Jack, your financial news writers don't necessarily have all the context. Let's just say that.
Jack, you need to learn something from CNBC. They watch the halftime report. Jack, if you watch the halftime report, your Twitter writers will be more well informed.
That's right.
Oh my goodness, the CNBC propaganda machine has been out on Bitcoin the last few days too, but trying to scare everybody into the nether void.
Are they going that?
Are they going to lose their golden goose?
So they've been bashing Bitcoin big time. Hey, who hasn't been bashing? Since we're talking CEOs, MicroStrategies.
Bitcoin. I don't get it. It's down 2 days, and yeah, it's volatile, but it's not abnormal for anything else Bitcoin's ever done.
You know why Bitcoin will never drop to 20,000? Because that's where I have a buy order.
Well, if my analysis in the podcast it proves out and it does go to 20,000, Tim, I'm going to the island at this point.
Well, that's why I have a buy order. See me again. Nothing I ever really want drops to the levels in which I'll purchase. So that's why. Hey, MicroStrategy CEO, since we're talking CEOs and Bitcoin.
But, wait a sec. Are people really crowing out there in social media land about how Bitcoin's garbage now?
Oh my gosh, are you kidding?
The quick take, hot take.
Hold on. Guys, I don't ever, and when I mean ever, I don't ever read comment sections on anything because I hate them. The fire in me builds way too aggressively. And so I need peace and prosperity. I don't need that in my life. But are people really coming out of the woodwork saying Bitcoin's garbage now because it hasn't seen this price since last Wednesday?
Yep, a lot of them. Are you kidding?
That's pretty stupid, guys.
Really stupid.
Well,
pretty dumb.
Getting the MicroStrategy CEO on the other side, he's like, Bitcoin's going to have a market cap of $100 trillion.
Lord Almighty. The dollar doesn't even have that.
The entire global currency system doesn't have that. I'm out. I don't think
the entire global currency market.
Come on, everyone. Do your best Dr. Evil impersonation. $100 trillion.
I got nothing. Bitcoin's crazy. News headline. All right, Bitcoin's crazy. Moving on. I mean, it's hitting the top there. It's coming down.
Do you guys remember that tweet that it was criticizing, what was it? I can't remember, but it said, if you just gave everybody $1 million, oh no, it was it was Bloomberg.
I remember that.
Putting $200 million in ad spend, right? And there's this dude that tweeted, yeah, but you could just give everybody $1 million. And it's like, that's not how math works.
Do the math.
This isn't how math works, guys.
Is that Common Core math?
Oh God. Don't.
Listen, I did some Common Core with my daughter yesterday. Man. I'm not sure that's how math works either, but
does anybody have anything insightful or smart to say about
I don't. I got snarky and sarcastic comments that no, I got nothing today.
red
you
candle.
get this overextended in the short term, I don't care if, once again, Bitcoin's volatile on its own, but you see this when you get overextended in the short term, you're going to have some big pullbacks, and that doesn't mean anything other than that's just the way price action works, right?
What's today? Is it another day that ends in Y?
It is.
Well, Bitcoin traded today. Lord Almighty.
The sun is up. Bitcoin traded. The financial news media doesn't know how to write a headline. Yeah, we got it. Moving on. That is Skyline, by the way. We're going to get into stock talk here next. Got a couple of corporate items I do want to get to. And for the end of the show, actually, I want to hear from Emily. She's got a couple of trade ideas that we're going to talk about. So we're going to go through a couple of things real quick here, Matt. First off, let's just talk CCIV.
If Bitcoin goes down 70%, nobody should be surprised, and nobody should ever even let their heartbeat get stronger, because that's what Bitcoin does. And if you don't know that, you shouldn't be trading Bitcoin.
So you did have something insightful.
I have a lot more to say, but I'm not going to.
So you did have something insightful and smart to say. Let's talk stocks. CCIV here next. Let's bring this one up. It was all over the headlines and media. There's been a rampant speculation around SPACs. There. He doesn't want to. So badly he wants to go back to Bitcoin to rant. But Matt, you can have plenty of opportunities to rant on this one if you want to. I can tell you that. There he is. All right. Listen, I got coffee, bro.
I'm just going to leave it on.
Did the mothership take over his mic again, or
listen?
Or he's just not talking?
Saudi Arabia took my internet privileges away. We'll just leave
it at that. Bring up the CCIV chart if you can, sir.
They need to pull up a weekly chart if they're going to say the end of the world is happening on something. Like, they need to do that.
Well, yeah, they need context and intelligence and thought instead of just trying to smash headlines out there and get people to click it. Yeah, I'm with you. 100%.
Like, listen, wake me up when Bitcoin breaks the weekly 9. Like it's just, you're gonna have volatility. It is so easy.
You want volatility. You can't go straight up, guys.
Tim's going to troll me for a week straight on everybody saying something stupid about some asset class now.
I'm going to bring it up,
and I hate it.
Yep, I'm going to find
it's
dumb headline of the day. Dumb headline
next
of the
Tuesday. I'm going to bring the best of the message boards next Tuesday that I read from now till then. So,
okay,
yeah, it's happening.
All right.
I was joking.
Tuesday is official. Troll Tuesday. Troll Matt Tuesday.
All right.
I thought we did that on Mondays with Penny Stock Mania.
Oh, listen, this is the gift that we can find different angles 5 days a week.
So this is going to be a daily occurrence. Let's see how high Matt's blood pressure can go.
I think we'll increase viewership.
The message boards trolls. Moving on, men and women here. Let's go CCIV. Market, give the news. What happened?
Hey, CCIV gave a clinic to a lot of new traders. So CCIV, for those unaware, CCIV is a SPAC, and there has been the rumor that, going on for about 5 weeks now, that they were going to merge with Lucid Motors. And Lucid Motors is a new, well, they're not new. They've been around 12 years. They've never made a car yet. But
what's another 12 years?
A luxury EV. Cars designs look actually beautiful. I think they're beautiful. But anyways, Lucid became one of this hot new thing, right? Who knows if it will remain that way or not. Time will tell that. But there was a lot of, I want to get into Lucid. I want to get into Lucid. And you just look at the price action on the daily 9. Look, every time it came, bounce, 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 bounce. I mean, it was hot. It was furious. As rumors continue to say, hey, the deal's close, the deal's close, the deal's close, price exploded up. All right. So all of these rumors that they're going to deal. Well, Lucid announced yesterday that they had completed the merger with Churchill Capital 4, CCIV. Michael Klein is a well-known SPAC guy behind it. Anyway, so they announced the merger. Merger's done, deal's done. Let's start the de-SPACing process. Well, after hours, CCIV started to plummet after hours. I was following all afternoon. Plummet. A wild price action to the downside, stabilized a little bit today, you know, stabilizing right now a little bit in the 38 range, but that's just short-term technicals. But that's what happened. Huge explosion, mania on the way up, deals announced, and well, you got quite the clip today.
This is a fairly aggressive chart, and it would be one of the more aggressive buy the rumor, sell the news type I've ever seen.
Yeah, I would agree with that.
Yeah, and the thing about it is, right at the, you know, when the deal was announced, the selling pressure started immediately. It felt orchestrated to me in watching it happen in real time. And then, of course, people panic and they jump on board. And what's happening? I've never idea. I thought stocks only went up. You know, it was pretty crazy yesterday on this. But Lucidae, actual company now, the de-SPACing process has begun. You know, another month, 6 weeks. Eventually, CCIV will turn into, I don't know what their new ticker symbol will be, but will turn into their new ticker symbol.
Can I ask a Tim question, like a question Tim would ask at this moment? I thought all specs were like under $5. What were we looking at CCIV at 60?
Well, what happens is when a SPAC comes public, they start at around $10, but they're tradable, right? And so like anything, you know, that is tradable, whatever, you know, once something and such as this, and it's very seldom that a rumor circulates this early before they actually merge. But it started with Churchill, and because it's tradable, people started speculating, and then the speculation price went up, and then people didn't want to miss out, and then FOMO kicks in, and then price goes up, and they feel like it's free money, and that's what happened with the speculation here.
Listen, I mean, there's a lot going on here. Obviously, you've got the SPAC, de-SPACing process that's working its way through. You've got institutions, you've got people assessing valuation. Apparently, they somehow doubled valuation. I don't care if they quadruple or 10x valuation, whatever it is. This company's not sold a car yet, guys. Can we at least have a conversation about that? They've not actually sold a car. You know, we ran a speculative company. I think I even read earlier that Lucid will have a higher market capitalization than General Motors and Ford.
Well, that was yesterday. That got cut a bit.
I still think it's way out of whack. I understand we live in a crazy world where we can just run through themes and theses and start running these no earning stocks to the moon and all that kind of stuff. But
to say that this is a highly speculative bet is the understatement of the day, right? You know, like you're speculating on a company that may or may not put out a car that's received by the public. I mean, talk about, I mean, it's a speculative bet, you know, and so,
yeah.
But, you know, once people get FOMO and they hear their buddy making money on a stock, they want to follow suit, you know, which can cause this insane price action in the short term.
Mm-hmm. And I'm not saying it has to happen to Lucid, but didn't we see this story play out last year with Nikola? Almost identical. This high car company that's going to make this amazing.
The only difference was that the Nikola craziness happened after they merged. There wasn't the pre-run up; it was after the merge, but same general principle, right?
Yeah, fair.
I don't think we know yet whether it's different or similar.
Mm-hmm.
I mean, but you did have that money out that, Mark. You know, all of us, I think, are fairly new to SPACs, and not only the creation of the SPACs, even though SPACs are not a new development, they're new in how we approach them in the marketplace, and especially.
You're breaking up, Matt.
Mothership.
Are we? I think we're finally.
The internet problems, guys. Mark,
yeah.
If you can get that, is my internet back?
It's back now. Yep.
All right.
Back.
I'm going to ask a question.
And it's gone.
Now it's gone.
And
it's gone.
The Saudi princes have joined with CIV longs to squelch.
Hold on.
That's internet.
Let me get my charts up here.
I wanted to hear the question too.
I do want to hear the question. It
sounded like
as
a thought. Like I want to, you know.
Anyway, So we're talking CCIV, obviously, and I think Matt was dialing up a question about just the nature of how these SPAC things work. I know we had a podcast on SPACs. You go from the introduction of the SPAC as CCIV. You have the run up in speculation. You have the merger announced. Now they're going through the de-SPACing process, turning into a company. I think what he was going for is just kind of a quick explanation on what that.
Matt says,
what all
how
that
many
is.
SPACs have delisted, and is there an edge performance when they announce? Well, the pattern on announcing, and once again, most SPACs, almost all, I mean, it's very rare to get speculation this far in advance that a company, in fact, I've never seen this level of run up in a SPAC, as far as from 10 to, what was it, near $65. I mean, this is an extreme example of the speculative run up that can occur before a merger isn't announced. This is not the norm, to say the least. But normally what you see, normally what you see on SPACs, the process is a deal is announced and there's a big spike in price. And then it settles down and it drifts down and it drifts down. And depending on how popular the SPAC is, floors are formed in the short term earlier or later, depending on just a lot of different things, basically sentiment and that. But normally there is a spike. Well, they're not normally. There almost always has been a spike on the news. I mean, pull up CLOV just as one of many examples I could give. So like big spike on the announcement, and then you can have a sell-off, and where that floor eventually forms, nobody knows. Nobody knows.
I mean, the obvious key difference here is they made the announcement and then they spiked and then they sold off, right? But when they made the announcement, we were talking at a chart at the low price, somewhere around that $10 mark. On CCIV, you're talking about a stock that went parabolic before the announcement. It's just, I guess this is so new. I think we're trying to find a pattern of how these behave, and I think we don't know yet.
Yeah, I mean, this is the rarity. I mean, this is the unicorn right now. It's probably not the last time, though, that a SPAC is rumored with a popular millennial type product that has a run up like this.
But can we not just discount Tim's concern, though? I mean, to sell a vehicle, we do not know the demand for it.
Oh, is it right? Oh, if you're investing in this,
it looks like a beautiful car. Don't get me wrong. I've seen the marketing images myself as well.
Yeah, but so did Nicola's vehicle look like a beautiful car. I can go have my daughter draw you some pictures and make some beautiful pictures too. They still haven't sold the car.
$1 billion valuation on those pictures. Just put it out there. Let's get it into a SPAC. We'll figure it out.
Yeah.
I know.
I guarantee I can call something lucid.
The Lucid Air, an $80,000 car that will give you 500 miles in battery technology on the drive time. A lot of people do believe in the tech.
Air,
there are bulls out there.
I know, but Tim, it doesn't make you the old fart who just wants to invest in Ford by pointing out the fact that this company has not sold a vehicle yet.
And how many stories around Ford and GM have we had in the last 6 months? They're going towards EV too.
Yeah.
Listen, I don't know.
Listen, this industry is a $10 trillion industry. It is massive. It can have many, many players in it, no doubt about that. But not every one of these companies can be the next Tesla.
They cannot.
In fact, they're not. Well, I mean, listen, the next Tesla is probably Mercedes-Benz.
The
or
next
GM
Tesla is
or
the
Honda,
current Tesla.
You know? Well, depends on how many Bitcoin.
We're not done with Tesla yet, guys.
Depends on how many Bitcoin Elon buys.
We're not going.
They're still in the growth era. I do that today. I can't. My internet's not stable enough for handle that conversation.
No. All right. We're going to give the news on a couple of different corporate items. Then we're going to get into Emily's picks here and kind of make a transition off to CCIV. Obviously, the market's talking about it. I have my personal concerns. Maybe I am the old fuddy-duddy, but that's my job, and I'm not going to apologize for it. It's just the way I see it.
Listen, if by old fuddy-duddy you mean sane and rational,
I hope so.
I guess you're the. I mean.
I hope
If
you
they're-
guys would tell me if I start moving away from that. But let's talk about a couple corporate items. Mark, in New York City, you'll be able to go watch a movie in March, starting March 5th at 25% capacity. Theaters are getting a little bit of a pop here today. You still playing these? You still interested in the theaters at all?
Cinemark's ran around from prices that I felt were super bargains. AMC, once again, I have some sold puts in the $3-4 range that I'll play on it, like, you know, if price drops. But you know, if it's not a super bargain, I'm not really interested. So AMC's turned into a momentum stock, you know, like both good and bad.
And we're going to go through the news pretty quick because I want to get into Emily's picks. I know how good some of those setups are. I want to have that conversation. Carnival Cruise Lines actually is issuing $1 billion worth of equity, and the stock is still rallying on that. I guess if you sell a bunch of supply of a product, the price should go up. Makes good sense to me. No, it doesn't, as a matter of fact, but the stock is running on that. Obviously, general reopening around cruise lines, airlines, they've all done pretty well here the last couple of weeks.
No,
Well,
I mean,
TL keeps
go ahead,
moving.
man.
Go ahead, Matty.
Yeah, I was just going to say on Carnival, there's context there. Carnival was trading down on the day. Carnival responded bullish on the intraday as it came into 24. 24 is a historical support level
Bang that support. Sure did.
for that. It also responded bullish as it started recovering on the intraday as well. So sell on the news, and that is what it should do. It responded because it came into support level. Shopify also had a stock offering today, SHOP. Shopify had a 1.18 million shares listed at 13.15, and Shopify trading down on the day.
Yeah.
So yeah, we've seen numerous examples in recent history of companies going up on stock offering. Carnival's one of them. I think they found support.
A couple of stories, obviously, around those fronts offering shares, trying to find some support on those charts. But actually, let's just do this. Let's get into Emily's picks. Emily, you're up. I know that you do this every Tuesday. You're trying to bring stuff, in terms of, good setups for our community out there that you're watching, you're paying attention to. What do you got first there, young lady?
Well, the theme really hasn't changed, this week and even into last week, where we've seen the strength in financials and energy. And of course, like Mark said, even during pre-production, the play is in financial energy and reopening themes, right? And, case in point, you can see with the cruise lines and the airlines and, everything else. But I'm still in the energy space. Like I told you guys last week, I really haven't had any exposure to this space. And in the podcast, you guys talked about CVX, and I want you guys' take on analysis on CVX. So if you don't mind pulling that up for me there.
Sure.
So we had that double bottom, and then we had that W cup and handle formation. It broke out at that 95 level. And I'm looking at this going, all right, did I miss it? So I'm thinking about this on a long-term perspective. And like I said, it's even when you factor in seasonality in energy, I want to make this a position trade. So I'm looking at this and I'm going, I can either just go out and get the equity and just do something like covered calls with that, or I can, do a modified cover call and look at a poor boys cover call, do, maybe, 4 months, 6 months out and sell a short call against that. So that's kind of like what I'm looking at this space. But, did I miss it on CVX or do I still have a chance?
Mm-hmm. Mark, why don't you go first on this Chevron?
Yeah,
one?
no, listen, I like, yesterday was the biggest in 2 years, people flowing in. I think the flowing has just started. We always when you think from swing trading and certainly day trading, I mean, you need precision entries. You really do, because you're in for a few days. You might be in for a week. You need to get the run. I think when you have position trading theses, that you're trading as much on the thesis as you are the technicals. I mean, if you're a few days late, I don't think that's any big deal. And I mean, Matt talked about it yesterday with oil stocks. Matt, brought up a chart. I don't think you're early. I think that applies here. I don't think you're early on this. If you're right on energy on this position, if the Goldman, if the JP's pushing their trading desk to this, rotation that you hear, I think you're plenty early still.
Yeah. I mean, let's take a look at some of the longer term kind of views on this thing, Emily, and have a discussion about it. Obviously, I agree with Mark, his sentiment around that. It doesn't mean Chevron's a good swing trading stock. And so some of the strategies you mentioned, poor boy covered call, leap options around spreads or something like that does make sense to me. I still believe equity makes a lot of sense in these dividend payers. If you are thinking truly a little longer term, Mark, 6 months, 12 months, a year, 18 months, something like that. Depends on your timeline for these energy plays, in my personal opinion, on how you should play it. CVX got crushed with the pandemic like everything else did relative to much in the energy sector. I mean, CVX from its peak back in 2014 is off of what, $35, 35%. Where if you look at that and you compare that with, say, crude oil is still off of their peak, $100 down to $60, so 40%, same kind of thing. Crude is now back above all the moving averages, like Matt and Mark have been detailing, and Matt did such a good job on the podcast discussing that important implication there. So around the energy thesis, the idea that I'm late on $100 stock that just broke out of a consolidation for a couple months, that's not really at the all-time highs like so many other companies are, you're not late. It doesn't necessarily mean it's going to go straight up or anything like that, but you're not late in that regard. Timing it here, there's a couple of tricky things because this candle is a very impressive candle from a price perspective short term. I would love a couple of different scenarios. If you consolidate for a bit, let the moving average catch up, then break out, that's fine. But honestly, quite frankly, with momentum, if you are believing in this move, if you go above this candle today, that's above $100. High was 116. You're clipping a round number. It took, from November. I mean, it took 3 months for this price to kind of consolidate back and forth to get to this point where we're breaking out. We're 2 days into the breakout. Would I always prefer to catch something clean? 100%. As a trader, you want to catch it clean. You want to catch the entry point when it's right there, step system rules in your design. So there was an entry yesterday. There might be an entry even very soon off of this, or you could even be patient waiting for an entry on how you're going to play this and developing. But in the general thesis, no, I don't believe you're too late on Chevron at all. And there's several different ways you can trade it.
All righty. Next one I have for you. This one is an easy one here. I'm looking at SKY Sky.
Skyline.
I love stocks. When you get these volatile environments, it's really hard to push up. But man, I love it when stocks hold their own in these volatile environments.
Yeah, and you can see when, it didn't participate really in that action that happened today with the sell-off. It's still kind of holding high basing. So this is a clear trigger above that 45.10 if we use step system rules.
That thing's beautiful.
Play the equity and just do, 10% above the ATR and just trade the stock. I don't like the options. The options are not as liquid. So this would be an equity play for me. What do you guys think?
Thumbs up and 2 thumbs up. And once again, I got to when you get really nasty sentiment conditions and the price action to the downside in broad market, and you get a stock like the oil stocks, right? I mean, look, that was a beautiful candle on Chevron, right? As far as the price action, when you get things saying no, I mean, they have a hard time just skyrocketing because that's really hard when the broad markets are selling off. But when they can hold their own, man, you got to have this on a watch list. I'll play that 10 out of 10 times in these market conditions with that setup. Break above 45.10. Looks pretty sweet to me. What do you think, Tim?
Several things that are obviously very impressive in this chart. And I do think the equity side of it, stocks, guys, 2021, we've been talking about this for a while now. You can trade stocks with zero commissions at many brokers. So there's a way to enter into that. In fact, even the biggest ones like TD Ameritrade and so on and so forth. So you can always play stock, even if you want to play 50 shares, 100 shares, whatever it is. There's cleanliness on the entry up here, which is one thing I really like Mark was discussing. I also like where this move started, Emily. See, the move was in a very casual trend here. You can see momentum rolling back and forth, consolidation, attempted breakout, pull back into the earnings report here, okay? So you can kind of feel what the price action and the narrative was in the marketplace. Came down, banged the 50, running on earnings, gapping on earnings, held the gap momentum. Now we've got a high base consolidation after the volume burst down here and the increased momentum off of a news catalyst like an earnings report. So some of those backdrop characteristics in a chart, they grab my eyes when I'm looking through this. I think this is a fair play if you're looking for a trade on stock. I'm looking probably a swing trade here is what I would say, step system principles, but I'm sure there's a couple of different ways you can design it. I think it's a good setup. You need confirmation, you absolutely do.
I
But
mean,
I think
that
it's
chart
a
tells
setup.
a good story, doesn't it?
Yeah.
It just tells a good story.
Yeah, sure does. Very
Yeah.
good. Couple good ones there, Em.
Yeah, and then that's all I got. And then you actually brought this up earlier. We missed Disney. Disney just has been chugging along, and everything else has just kind of been falling apart. And Disney's like, well, I'm just gonna give you new highs today.
Disney's not a swing trading company. So
No,
let's
it's not.
make sure we're clear about that. It's not a great swing trade stock. But man, look at the impressive momentum here the last couple of days, guys. Matt did a great job detailing the earnings report, thoroughly back when it posted it on the 11th. We went through it, how they were blowing out on subscription numbers, the general reopening theme that they were highlighting moving forward started fitting the narrative. And look at this here, Mark, today. With a lack of news catalyst, Disney's breaking out and running up 3.5% while the market is really stalling and having a hard time. That's momentum. Those are beautiful candles. The size of candles matter. Big green candle, okay, little volume pickup, okay. Big green candle, no sell day so far. Here we are up at the highs, playing great offense.
The chatter out there really is really simple. Energy stocks, financial stocks, reopening plays. Disney fits the reopening play. It was highlighted on CNBC by Kramer himself yesterday, like, hey, we got to get out of tech and we got to go get into something that make us money the next 3 months, right? I mean, that's the sentiment. Can the sentiment hold? I think it's got some juice, right? It makes a lot of sense as long as COVID cooperates. Now, that's the big wild card. If that were to shift, the whole narrative of everything shifts. But I mean, reopening, financials, energy stocks, that's what everyone's talking. I think there's juice on this. In fact, I immediately went to some bull call. I mean, whenever I get a stock this pricey, I usually try to look out at bull call spreads, see if I can find a cheap one that makes sense. That's how I would approach it. Emily, what do you think?
Yeah, I was looking at something similar to that, doing some bull call spreads on this position trade, not a swing trade. Going to be in it for a minute.
Interesting setup. And by the way, if we're talking a little bit longer, let's peek back at the long-term weekly. In fact, let's even give me a long period of time. Look at the strength of this company over the last 10 years, guys. Juggernaut absolutely shook off the pandemic, rallied back. We're now breaking the new highs with momentum and a good theme behind it. Yeah, I think that you should and could be absolutely very interested in Disney from that perspective. Emily, I love it. Very good ones. Very, very good, young lady. Mark, obviously we lost our driver here today, so we're going to move into final thoughts. Poor Matt, the internet gods. You brought up Saudi Arabia, and then boom, the internet gods.
He brought up Saudi Arabia, and then the death knell when he's tried to get message boards, millennial traders on CCIV. It was just too much. the two, I mean, Saudi princes and millennial new traders. That's just too much to handle. Listen, final thoughts are pretty simple for me. Listen, we always talk about not being over leveraged. I mean, these are the little stretches. Why? If you woke up in an absolute panic at today's price action, one, you're either inexperienced or most likely you were stretched too thin. And those big red figures. Listen, my account was down, Tim. I have no doubt you and Emily's account was down this morning. Yeah. I mean, that there's really no way to avoid it. I wasn't 100% in energy stocks, like I'll never be 100% in nothing. But not being over leveraged helps you make really good, calm decisions. Because every day and every week's not going to be a winner. Doesn't mean trading can't be extremely, extremely profitable. In trading over time, you learn, if you want to be successful, to not overreact. When something is skyrocketing up, you learn not to let FOMO take over and be irresponsible. And when price action is nasty on the downside, you learn not to overreact and stick to your plan. Not overreacting in both extreme conditions, extreme FOMO and euphoria, and when things get a little nasty, That is a skill set that you will slowly develop over the years. In the short term, until that skill set develops, try to come up with a plan and then execute that plan, and do not do knee-jerk reactions, either when the price is skyrocketing or when price is plummeting.
I'll even, I'll give it to Emily actually, and then I'll have my final thought. Emily, go ahead.
Same sentiments as Mark. Even cash flow traders on a day like today, your account is red, right? So
Those
nothing.
cover calls can't offset at all.
Right, exactly. So nothing. I know it can look like it's frightening for somebody who's brand new. And like Mark said, if you've been trading just for the last 6 months, yeah, this is like, what in the world is this? But these things happen, right? And you just trade as usual. You can't let that spook you. Now, obviously, you already have your stop losses in place prior to obviously this happening. So if you're swing trading, yeah, today maybe you took a ding on all your swing trades, but your position trades should probably still be okay. Just give them time to just do what they do. So it's nothing to worry about, but something to be watchful of, and watch for those moving averages. So we close above the 50, try to get back to that 20 moving averages, looking for new positions to get into. I mean, it could be a nice buying opportunity, especially if we start to get back up above those moving averages. So I mean, it's just another day, but obviously, just one of those days that you just keep an eye on and just look for new opportunities, right? But just trade as usual.
Mm-hmm. I think that's a good mindset to have in general. Trade as usual. Your approach to the market should not radically change whether or not the markets are up, markets are down, or you're profitable or losing on a given day. Obviously, we all have emotions that get pulled into it, guys. But the reality is, those of you out there who are veterans, you know how this game works. You keep position sizing relatively smart. You make sure that you're cautious. You understand portfolio balance. You don't get swept up in just momentum moves all the time, and you learn to take a hit when you need to. But then when the opportunities pop in, still got to do your job. You still got to do your job one way or the other, either entering into new positions, managing existing positions, you name it. Obviously the market, whenever you get red candles, veterans start thinking, okay, how do I give this context for my beginners out there? And it's very simple. Prices go up and down. Your account will go up and down. You will have gains and losses. That is a natural part of trading and investing. Learn how to mitigate it, learn how to understand it so that your emotions don't dictate your decision making. That's the best advice I can give anybody on any given day, especially on a day where maybe there's a little volatility in specific accounts. But like we looked at with Chevron and Disney and others, there's also all kinds of great stock opportunities out there too. Don't avoid those if they do set up properly and they fit your rules and all of those kind of things. Guys, we're done here for our Tuesday show. Emily, as always, thank you for being here and bringing your positive attitude. And
all I know, Emily, listen, I didn't play Dick's Sporting Goods, and I should have. I like the Exxon was tagged on that. I've learned, listen, you bring winners. And, I'll be hesitant at first whenever that, but when someone starts giving me a winner, the spite in me comes out, and I'll be like, I'll be damned if I don't make some money.
If you trade one of my picks, I will consider some of your SPACs. How about that?
Yeah.
Yeah, no, you won't.
No, that doesn't fit the Queen's MO.
I'll let you kill me in Among Us. How about
you, but I don't believe you for a
Us.
second.
Yeah. And Craig, I get it. Craig says 6 days in a row, not just one day, ladies and gentlemen. I get it. Markets have been hesitating now, selling a little bit. We got to deal with it. And until we get price confirmation going back up, we don't know where this little support pivot might hold, but we're going to break it down, analyze it day at a time like we always do. And we'll be back tomorrow to do the same thing. By the way, pro membership trial is in the comments of every YouTube video. If you're out there, you've been sitting on the fence, you've been hesitating, you've been waiting, it is a great time to get started with education. Make sure you're around coaches that can answer your questions. We got a coaches show tonight. We have a traders lounge every morning where there's a lot of engagement, all that kind of stuff. There's no reason to hesitate. Click the link, come and join us in the pro membership.